Yeah, good afternoon. Well, in today's class, we will be discussing our Unit 5, that is on Treasury bills and call money market. So, first of all, we need to understand about the meaning of Treasury bill. Well, we can say it is also denoted as T-bills. So, basically, Treasury bills are short term debt instruments issued by the government to raise funds for a very shorter period of time. We can also say that they are one of the most secure and liquid financial instruments in money market since they are backed by government. Well, these T-bills carry minimal risk and making them highly attractive to the investors seeking safety and liquidity. Well, let's understand more about treasury bills in the upcoming definitions. Well, a treasury bill is a short-term government security that is issued at a discount to its face value and does not pay periodic interest. Instead, investor purchase T-bill at a lower price and receive the full face value upon maturity. Also, the difference between the purchase price and the face value represent the investor return. There is one definition which was given by IMF, that is International Monetary Fund. It defines treasury bills as short-term securities issued by the government, usually with maturities of 1 year or less. So that is a shorter period. Further, it says sold at a discount to their face value and redeemed at par upon maturity. So these are treasury bills according to IMF. Next definition is given by RBI, that is Reserve Bank of India. It defines treasury bills as short-term debt instrument issued by the government of India to meet short-term borrowing requirements with no coupon payments but issued at a discount and redeemed at face value upon maturity. So, it can be said that T-bills serve as an important tool for the government to manage its short-term financial needs while providing a risk-free investment option to investors. I hope it's clear now. Now, let's discuss certain key features of treasury bills. The first feature is it has a short-term maturity. Well, T-bills are issued with short-term maturities, typically ranging from a week, you can say, to 1 year. Also, common maturity includes 91 days, 182 days, and 364 days. These are the common maturity periods of treasury bills. What? 91, 182, and 364 days. Now, the next feature is it is issued at a discount. Well, treasury bills are sold at a price lower than their face value. So, investor earn a return based on the difference between the purchase price and the face value at the time of what? Maturity. So, that is what? A treasury bill that is issued at a discount. Next key feature is zero coupon security. Well, treasury bills do not pay periodic interest, that is coupons. So the return is generated purely through capital appreciation. So that is zero coupon security. Next feature is high liquidity. We have already learned about liquidity. Now let's see how it serves as a key feature of treasury bills. Well, the T-bills are one of the most liquid financial instruments as they can be easily traded in the secondary market. So investor can sell them before maturity is needed. So the key feature is they are high on liquidity. Next feature is risk-free investment. Since they are issued by the government, T-bills carry no default risk. So they are considered among the safest instrument in the financial market. Okay. Next feature is competitive and non-competitive bidding. So that is investor can purchase T-bills through auctions conducted by the central bank. So in competitive bidding, investor specify the discount rate they are willing to accept, as well as in non-competitive bidding, investor agree to accept the weighted average yield determined in the auction. So that is competitive and non-competitive bidding. Next thing here is issued by the central government. So yeah, only the central government issues treasury bills. State government do not issue them. So mind it. So these bills are always issued by the central governments. Next, the last feature of a treasury bill is it is used for monetary policy operations. Well, central bank use T-bills to regulate money supply and liquidity in the banking system, as they help absorb excess liquidity from the market. So these are the various key features and the important key features of treasury bills. I hope I'm clear here. Yeah. Now let's move on to our next thing regarding T-bills. Yeah, we will get to know about this features. Now we'll know about the types of treasury bills. Well, treasury bills are basically categorized on their tenure. Okay, so how for how long you can hold a treasury bill. So on the basis of that time period, these bills are classified. So the first time period is from 91 days. So that is 91 days treasury bill. So 91 days treasury bill is the shortest maturity period. Also, it is ideal for short-term investment and frequently used by the financial institutions and corporations. That is 91 days treasury bills. Second type is 182 days treasury bills. So they also known as medium-term treasury bills. They provide a balance between liquidity and slightly higher returns. Now, the third type of T-bills are 364 days treasury bill. So these are known as longest maturity among treasury bills and also suitable for investors who want a risk-free investment with slightly better returns than shorter term bills. Well, in some countries, very short-term bills such as 14 or 28 bills may also be issued occasionally, but not in India. We have these three kinds only, like 91, 182, and 364. So they are saying that some other countries, this tenure are quite less, up to 14 and 28 years. So, but in India, we have these three types only. Okay. Now, let's see how this treasury bill work. How do they work? So the first thing is auction and issuance. Well, the T-bills are issued through auctions conducted by central bank, such as the Federal Reserve in the US or RBI in India. Also, investor bids for T-bills and the government determine the final price after the auction. Next is discounted price. Well, suppose a government issue a 91-day treasury bill with a face value of $1,000. So an investor may purchase it for $980. Upon maturity, the government pays the investor $1,000, resulting in a profit of $20. So that what I was telling. Ki you purchase at a discounted price, but at the time of maturity, you get the face value. So face value was 1,000, you purchased at 980, and you got at the time of selling, you got a profit of $20. Now, redemption at face value. So at maturity, The investor receive the full value of T-bills and no additional interest payment are made. So this is how these treasury bills are issued, auctioned is being made, and how it works. I hope I'm clear here about treasury bills. Now, we'll move on to the advantages and disadvantages of treasury bills now. Well, ad coming to the advantages, the first advantage is safe investment. Well, it is backed by government, so making them virtually risk-free. Next advantage is high liquid. Well, they are easily tradable in the money market. Next one is short-term commitment. Well, investors do not have to lock in their money for long periods. S- So that is short-term commitment. Next advantage is they are useful for institutional investors. So banks, mutual funds, and corporation use T-bills for short-term cash management. Next advantage is good for monetary policy. Well, usually central bank uses T-bills to control liquidity and inflation. So basically, they absorb the excess liquidity in the market. So that's the advantages of treasury bills. So they are a safe investment, they are high liquid, they are short-term commitment, they are useful for institutional investors, and they are good for monetary policy. Now, coming to disadvantages of treasury bills. Well, the first one is it is low on returns. So since they are low risk, the returns are lower compared to the investment like stock or corporate bonds. Next is no regular income. So investors do not receive periodic interest payments. So that feature is not there in T-bills about the periodic interest payment. Next is affected by inflation. So if the inflation is high, the real return on T-bills may be negative. Give me a moment, please. Yeah, sorry for the interruption. And the last disadvantage is limited investment option. So they are only available in specific tenures. We have already discussed in types that tenure is of 91, 182, and 364 days. Now, all in all, we can say that treasury bills are one of the most secure and widely used short-term financial instrument. They provide government with the means of raising short-term funds while offering investor a safe, liquid, and predictable investment option. Although they do not offer higher returns, their risk-free nature, liquidity, and ease of trading make them an essential part of financial markets. They are particularly useful for risk-averse investor, financial institution, and corporate treasuries. They need to park surplus funds in a secure and liquid investment. Moreover, central bank use treasury bills as a tool to regulate liquidity and manage monetary policy effectively. Thus, T-bills remain a fundamental component of government borrowing and an essential instrument in the global financial system. Now, give me a moment. We'll start the next topic in just a minute. We have already understood about treasury bills. Now, the next thing we'll discuss is about call money market. Well, uh, first of all, let's understand the meaning of call money market. Well, the call money market is a crucial segment of money market where short-term funds are borrowed and lent, typically for 1 day or you can say overnight or up to 14 days. So it plays a significant role in maintaining liquidity in the banking system and helping financial institutions manage their short-term funding needs. There are a few definitions of call money market. Let's see them one by one. Well, a call money market is a market where banks and financial institutions borrow and lend funds for a very short duration, usually over a night or up to 14 days without any collateral. Now, there is one definition which was given by RBI, Reserve Bank of India. It defines the call money market as a segment of money market where funds are lent and borrowed for extremely short periods, mainly to manage liquidity requirement and maintain reserve ratios. So that was the definition given by RBI. The next definition is given by the International Monetary Fund, IMF. It describes it as an interbank market where financial institutions trade short-term funds to meet reserve and liquidity requirement. Well, in simple terms, it can be termed as the call money market enable banks and financial institutions to meet their immediate cash requirement by borrowing from surplus funds available with other institutions. So those were the two definitions given by RBI and IMF. Now, check out certain key features of call money market. Starting with short-term borrowing and lending. So the call money market deals with extremely short term, typically already discussed, that is for 1 day or overnight or maximum to 14 days. Also, borrowing for 1 day are called call money, while borrowing up to 14 days are called notice money. So that is the important point in this, that if the borrowing is for 1 day, it is called call money, while borrowing up to 14 days, it is termed as notice money. Now, the next thing is the participants. Well, major participants include the commercial banks, the cooperative banks, insurance companies, mutual funds, and primary dealers. Also, non-banking financial companies, that is NBFCs, and individuals are not allowed to participate directly. So that was about the participation in call money market. That only major participants are there and non-banking financial companies and individuals are not allowed to participate directly. Now, the next feature is that no collateral required. Well, call money transactions are unsecured, meaning no collateral is needed for borrowing or lending. Next is regulated by the central bank. So, in most countries, the central bank regulates and monitor call money transactions. Next feature is call rate, also known as interest rate on call money. So the call money rate is the interest rate at which funds are borrowed and lent in this market. It is highly volatile and fluctuate based on demand and supply of funds. The call rate is basically influenced by liquidity conditions, monetary policy, and banking system requirements. Next is liquidity management tool. Well, banks use the call money market to manage short-term liquidity mismatches. The central bank intervenes to control liquidity by adjusting the supply of funds in the market. Now, let's see that how this call money market works. What it's the functioning. So the first thing is it is a lending and borrowing process. So, banks and financial institutions with surplus funds, they lend money in the call money market. And banks that face short-term liquidity shortage borrows money at prevailing call rates. So that is how it works. Now, also interest rate determination, how the rate is determined. So the call money rate is determined by demand and supply conditions in the market. And if liquidity is tight, like more demand for funds, the call rate increases. And if there is excess liquidity, that is, more lenders can borrow, the call rate decreases. Next is role of central bank. Well, the central bank intervenes by injecting or absorbing liquidity to stabilize the call rate. Also, it is done through open market operations, repo operations, and changes in reserve requirement. Also, let's discuss about the maturity periods. Well, for call money, funds are borrowed and repaid within one business day, that is overnight. And for notice money, funds are borrowed for more than one day, but must be repaid within 14 days. So that is for notice money. So this is how the call money market works. Now, let's discuss about the importance of call money market. Well, the first thing over here is it helps maintain liquidity in the banking system. Well, it enables bank to meet short-term cash requirement. Also, it prevent cash shortages and ensures smooth banking operations. Also, it serves as an indicator of monetary policy. The call money rate reflects the liquidity position in the economy, and central bank uses this market to implement monetary policy changes. Now, the next feature is facilitates efficient cash management for bank. Well, bank use call money, borrowing, lending to manage their reserve requirement and daily cash flow. Next one is affect interest rate in the economy. Well, changes in call rate influence other short-term interest rates like repo rates and lending rates. So this is how important call money market is. Basically, it helps maintain liquidity in the banking system. It serves as an indicator of monetary policy. It facilitates efficient cash management for banks, and also it affects interest rate in the economy. Okay, I hope I'm clear with the importance. Now, one important thing need to be discussed regarding call money is its impact. Well, the call money rate is the most crucial factor in call money market. It is highly sensitive and can fluctuate frequently based on market conditions. Well, there are factors affecting the call money rate. So let's know about the factors. The very first factor is liquidity condition in the banking system. So when liquidity is high, call rate decreases. And when liquidity is low, the call rate increases. That is the first factor. Next factor is monetary policy decisions. Well, a hike in cash reserve ratio, that is CRR, or the repo rate increases call rates. So, a reduction in CRR, or repo rate decreases call rates as well. Okay. Now, the next impact is demand on short-term funds. Well, higher demand for overnight funds raises call rates. Lower demand leads to a drop in call rates. So, it depends upon the demand. Next is inflation and economic conditions. Well, inflation pressures can lead to higher call rates, and economic slowdown may cause lower call rates. Okay. Now, the last topic of this unit is the advantages of call money market. Let's quickly finish off this so that we can start our next unit as well today. Well, talking about the advantages of call money market. Well, the very first advantage is it is quick and easy access to funds. That is, banks can borrow or lend money instantly to manage liquidity. Next is highly liquid and flexible. Well, funds are available on demand and transactions are settled quickly. Next is it helps maintain stability in the banking system. So it ensures that banks meet their daily reserve requirement. Also reflects monetary policy trends. So the call rate is a key indicator of liquidity conditions and monetary policy direction. So these are the basic advantages of call money market. That is, it is quick and easy access to funds. They are highly liquid and flexible. They help maintain stability in banking system, and also it reflects monetary policy funds. So with this, we will also discuss about the few disadvantages that will that a question might come along with advantages, or you might have to discuss about advantages or disadvantages in examination. So the very first disadvantage of this could be that high volatility in interest rate. So the call money rate fluctuate frequently, so creating uncertainty for borrowers. So that is the one disadvantage. Next could be limited access to non-banking institutions. That is, only banks are eligible financial institution can participate. So they have a very limited access to non-banking institutions, or individuals cannot participate. So only banks and the institutions that are eligible, those institutions and banks can only participate in this. Next disadvantage could be dependence on central bank intervention. So the market is heavily influenced by central bank policies. So this was all about the meaning, advantages, participants of call money market. Also, all in all, the call money market plays a vital part of financial systems, providing short-term liquidity to banks and financial institutions. It acts as a barometer for monetary policy, liquid conditions, and financial stability. Though highly volatile, it plays a crucial role in ensuring smooth cash management and also liquidity adjustment in the banking sector. So, by influencing the call money rate, central bank can regulate money supply, inflation, and economic growth, making the call money market a powerful tool in modern financial markets. So, I hope with this, uh, it's clear about the concept of call money market. Now, please give me a moment. So, we will start our next unit in within a moment. Just a minute, please. Our next unit is about, again, it is divided in two parts. These two parts are commercial papers, CP, and certificate of deposit, CD. Well, commercial paper and certificate of deposit are both short-term money market instrument used by corporations and financial institutions to raise funds. They serve as alternative to traditional bank loan and offer investor a relatively safe and liquid investment options. Coming to the first part, that is commercial paper. Well, a commercial paper is an unsecured short-term debt instrument issued by the corporations, financial institutions, and other large entities to meet their short-term funding needs. It is issued at a discount and redeemed at face value upon maturity. Also, the Reserve Bank of India defines CP as unsecured money market instrument issued in the form of promissory note by large corporations and primary dealers to raise short-term funds. Also, the US Federal Reserve defined it as a short-term unsecured promissory note issued by companies to finance their short-term liabilities. Now let's discuss about key features of commercial papers. Well, the first feature is short-term maturities. Well, CP have a maturity period ranging from 7 days to 1 year. Next is issued at a discount. Well, CPs are issued at a price lower than their face value and redeemed at full value. Also, the difference is the investor return, that is discounted yield. Next feature is unsecured instrument. So, unlike bonds or loans, CPs are not backed by collateral. Only financially strong corporations with high credit rating can issue them. So, that one is an unsecured instrument. Next is issued by large corporations and only financial institutions. So, they are typically issued by corporate house, banks, non banking financial companies, NBFCs, and government and small businesses do not issue CPs. Regulated by central bank. Well, in India, CPs are regulated by RBI, and talking about US, they are monetary by Federal Reserve and SEC. Well, talking about denominations, so CPs are issued in multiple of rupees 5 lakhs India, right? Next is credit rating requirement. So commercial companies must have a high credit rating from agencies like CRISIL, ICRA, Moody's, and S&P. And low-rated companies cannot issue CPs. Now, talking about the advantages of commercial papers. Well, the first advantage is it is cheaper than bank loan. The CP have low interest rate compared to short-term bank notes. Also, they are flexible and quick funding. So the corporations can quickly raise funds without lengthy loan approval processes. Next advantage is diversification for investors. Well, the investors get an opportunity to earn better returns compared to savings account or fixed deposits. Next is highly liquid. So the CPs can be easily bought and sold in the secondary market. So these are the few advantages of commercial paper, that they are cheaper than the bank loans, they are flexible and quick funding, diversification for investors are there, and they are highly liquid. Now, talking about the disadvantages of CP. So only large corporations, that is small businesses, cannot issue CPs due to strict credit rating requirements. Also, default risk. So since CPs are unsecured, investors face credit risk if the issuer default. And also not for retail investors. So CPs are mainly traded among banks. mutual funds, and financial institutions only. Also, no interest payment. So CP do not pay periodic interest and return are based on the discount. So these are the few advantages, disadvantages of CP. That is, they are only for large corporations. There is a default risk with that, and they are not for retail investors, and no interest payment is there. Okay, so that was about CP. Now coming to the certificate of deposit quickly over here. Well, a certificate of deposits, CD, is a time deposit issued by banks and financial institutions to individual companies and investors. It is a fixed term deposit that offers interest and is redeemable on maturity. The Reserve Bank of India defines a certificate of deposit as a negotiable money market instrument issued in a dematerialized form or as a promissory note by bank with a fixed maturity period and interest rate. Also, there is one more definition given by US Federal Deposit Issuance Corporation, FDIC. It defined it as a savings certificate issued by bank with a fixed maturity date and a specified interest rate, usually insured by a government up to a certain limit. Now, let's quickly look into the key features of CD. The first one is key fixed maturity period. So the CD maturity lies from 7 days to 1 year. Also, they are issued by banks and financial institutions. So CDs are used by commercial banks, small financial banks, and NBFCs. Next, it can be issued in physical or dematerialized form. So CD can be held in paper form or in electronic format. Next is it is interest bearing instrument. So unlike CPs, CDs pay interest at a fixed rate. Also, some CDs offer cumulative interest that is paid on maturity, while other provide periodic interest payment. Next is higher interest than saving accounts. So CD offer higher returns than regular bank deposit due to their fixed tenure. Also, transferability and negotiability. Well, CDs can be traded in the secondary market. Also, no premature withdrawal for larger investments. So, in some cases, institutional investor cannot withdraw funds before maturity. So, all in all, we can say that it has a fixed maturity period. They are issued by bank and financial institutions. They can be issued in physical or dematerialized form. Then it is an interest-bearing instrument. Then higher interest rate than saving accounts. Then it is transferable and negotiable, and also no premature withdrawal for larger investors. Okay, now quickly coming towards the advantages of CD. The very first thing is it is safe and secure. So CD issued by bank are considered low risk investment. Also, it is guaranteed return. So investor earn a fixed interest rate unlike stocks or mutual funds. Also flexible tenure. So CD offer range of maturity options like from 7 days to 5 years. Then higher interest rate than saving accounts. So CD provides better returns compared to normal bank deposits. So these are the basic advantages. That is, it is safe and secure investment. They give a guarantee returns. They are flexible tenure and higher interest rate than saving account. Now, let's see about the disadvantages of CD. The first disadvantage, it is lower liquidity. So the funds are locked in until maturity unless traded in the secondary market. So if at all it is traded in secondary market, otherwise the funds will be locked until it's get mature. So they are low in liquidity. Then there is a fixed interest rate. So investor cannot benefit from rising interest rate after purchasing a CD. So whatever has been fixed, that is fixed. So it will not change. Next is penalty for early withdrawal. So some bank charge a penalty for withdrawing funds before maturity. Let's take an example of certificate of deposit CD. Let's say a bank issues a 6 months CD for 5 lakhs at an interest rate 6% per annum. So upon maturity, the investor will receive 5 lakhs 15,000. That is 5 lakhs the principal and 15,000 interest will be there. So that is one example for CD. Now, both commercial paper CP and certificate of deposit CD are essential money market instrument used for short-term financing. CP are best suited for large corporations needing quick unsecured funds, while CDs, that is certificate of deposits, are basically ideal for conservative investors looking for safe and fixed returns. Understanding their feature, risk, and benefit help investor make informed decisions. So that was all about commercial paper and certificate of deposit. I hope I am clear with all the four topics which I have discussed today. That is treasury bills, their features, characteristics, advantages, disadvantages, and similarly for call money market. Then we have discussed about commercial papers and certificate of deposit. So these all four topics are quite important from examination point of view and might come as a short as well as a long answer with them. So whatever I have discussed in the class, that is sufficient enough to write in your examination. Yeah. So that was about all those things. Now, in the next class, we will quickly learn about the various markets, that is the equity markets, and under this, we will study about new issue markets, primary markets, and stock exchange, secondary market, and trading and settlement procedure. This topic is very important, this equity market, for your general knowledge as well as for examination point of view. Then we also have to study about debt markets. So under this, we will be studying about the types of debt securities and other things related to debt securities. Then we have regulation of capital market. Also, we will be studying about objectives and function of SEBI, power of SEBI and organization structure. Then we need to learn about foreign exchange market, and managing foreign exchange reserves. Then financial derivative market is there, again an important one, and we will be discussing about financial derivative market in India. And the last thing is commodity derivative market. So we'll be studying about types of commodities and advantages, all those things we need to cover under this topic. So that's all for today because time is not there for to start and finish off the next unit. So if any question is there on anything you need to ask, please put your question in the chat box or you can unmute and ask me. I'm there to answer. Thank you.